The weakness continues, and that is something that we can see in the Asian markets as well.
Focus in the economic survey is going to be on India's growth story.
On a consolidated basis, the revenue growth has come in at 11.5% year on year.
PCE data this week in the US, which will be very important.
Starts in the red. Let's see whether or not at some point of time we see an intraday recovery.
HDFC Bank has beaten our poll with respect to their P&L, both the NI and the PAT.
24,410 or so is where we are starting.
1-2 year basis, I am not negative on the market. And
we expect now the prices to remain range bound.
अमृत काल का एक महत्वपूर्ण बजट है.
The big morning dip and the Nifty has recovered more than 200 points.
A lot of it has been the first order and second order effect of regulatory changes that have happened in the past.
India has been fairly resilient when we talk about what is happening as far as the global scenario is concerned.
So the Nifty absolutely flat with some negative bias. It's down 15 points.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, last hour of trading coming up. This is a fresh new edition of Closing Bell, and it's the last hour of the day as well. A day before the union budget tomorrow. We're coming to you as always from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues Rima and Surbi here in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. In the morning, we got that dip being bought into, but thereafter things have been on the quieter side. But we are going into the big event very resilient. A 12% rally on the Nifty and the sensex. The mid-cap index has seen a 23% up move since the beginning of the year. So fairly firm.
Oh, absolutely. And actually, global markets to an extent, if you're looking at Europe right now, there's a lot of green out there because markets will now start reacting to the changed political landscape in the US with, President Biden stepping out of the race. So perhaps that's adding to some some kind of exuberance over there. But I suppose for us, even today, mid-caps are almost already celebrating the budget ahead of the event, right? Large caps still a little range-bound.
No, I think that is absolutely right. But also, to that point, I was just thinking before walking in, we had the election results, right? Markets were positioned absolutely one way.
Yeah.
And so there was a bit of a shock. Not a bit of a shock, there was a large shock. So I think, that memory is fresh. So you don't want to preempt too much also.
Yeah.
We've heard from everyone it's a non-event and budget is mattering less and less. And all of that is true, but it's an event and you need to kind of sort of trade through it. So I think that is a sensible way to look at things. Just a few more points before, we bring in our guests, etc. Nifty is flat. It's not a bad market, actually. Nifty is absolutely flat, but it's largely because of some specific stocks, and that's on the back of earnings. Reliance, Kotak, and Wipro. These are large names which are down. Reliance is down 3%. Kotak is down. Wipro is down much more. So, it's that kind of a pressure which is coming through. Single stock driven by earnings. On the upside, HDFC Bank is adding about 50 Nifty points. So there is a fair bit of pull and push happening. Mid caps and small caps, strong recovery. These indices sold 2.5% on Friday. Today they are up about 1.5%. PSUs within this mid cap broader market, PSUs as a pack stands out, and they're doing well. Overall market breadth is positive. 1,500 up, 1,000 down. And of course, budget tomorrow. So this, from a market perspective, yeah, sure. We'll get the big picture in terms of what the government wants to do over the next 5 years, and we'll, see this some measures for this sector, that sector. But I think because markets have done so well, stakes are high, and I think the number one thing to watch will be whether there'll be any changes on or even review as far as taxation on equities is concerned. So some quarters, some fear, but broad expectation is that they will not tinker too much, at least not right now.
I never thought that retail speculation will take such center stage, right? You had the Reserve Bank of India, you had SEBI, and today's economic survey. It was like almost 4 paragraphs devoted to how it could be akin to gambling and, it's not right, over-financialization is not good. It caught me by surprise. I don't expect that from that document, but, well, that's what we got.
Well, looks like collectively some action may come through now that all the parties are talking about it. But just a quick word on the way the large caps are moving today. So on the way down, it's Reliance Industries with a 3.5% cut, and that's at the low point. But that's pretty much the cuts or the losses from Reliance Industries are pretty much getting offset by the strength in HDFC Bank, which is up nearly 2%. Outside of that, Ultratech Cement, Grasim, M&M, NTPC is coming for some amount of buying. Wipro is the big laggard today, and ITC is subdued ahead of the budget tomorrow. Nigel.
Well, that's right. Well, let's get cracking then, and let's find out how do you trade the final hour of trade. We have our expert, Mitesh Thakur, who joins us. Well, Mitesh, for those who went ahead and bought the intraday dip, they're making some good money, both on the Nifty as well as on the Nifty Bank. And earlier today, we had pointed out that 51,800 mark is very crucial on the Nifty Bank. We bounced off that 51,850. What do you do right now? Do you take money off the table, or would you, recommend that those who have bought, they continue to hold on?
See, I think the index, has managed to hold on to the lower support levels, especially the Bank Nifty around this 51.9, 59.30 mark. So I think we got an intraday low slightly below that. But then for an index which is at 50,000 levels, 50, 60 point intraday dip below support levels is not very important. So I think today's low becomes the pivot now. As long as that doesn't get taken out, I think it's all is okay. But typically as a trader, we would tend to avoid the event. So we're going very light into the event. And that is something which I would recommend for most of the traders as well. Event will come with its own set of uncertainty, and therefore, you don't know which way it will play out. And that's much more difficult to guess. But on some stock-specific basis, there's good action. So maybe focus there. PI Industries is breaking out. Buy here with a stop at about 39.70. Look for a target of around 4,200 to begin with, and then maybe even higher levels. And on the other side, I think there's some reversal happening on the charts of private sector banks. HDFC Bank, you're highlighting AU Bank and HDFC Bank, both are in focus. AU Bank is now nearing the 200 average. I would want to see the stock get past 665 and then take a long trade with a 12-13 point kind of a stop. Look for targets of 690.
Okay, thank you very much for that. Let's talk about Indian Hotels. That's moving higher as the company reports a resilient performance in an otherwise seasonally weak quarter. The management commentary on the July pickup and hotel openings also excites the street. Mangalam joins in with the details. Mangalam, 8% gain now.
8% higher in today's trading session, and that's largely because, the company's posted a resilient performance in what was a seasonally weak quarter. Remember, in the first quarter, we had the elections, and as a result of which, there was the code of conduct that took away a lot of business from all these hotels. At the same time, there was the big heat wave, which prevented people from traveling as well. And add to all of this, the large contributor to the hotel business, which is the weddings, we had lower number of wedding dates as well. So 25% lesser revenue coming in on account of, lesser wedding dates from that part of the business for the company. Despite that, what is it that the company did? Reported a record performance in the first quarter when it comes to absolute numbers. So there was a 5.5% growth on the top line. They managed to hold on to their costs, and as a result of which, margins improved by about 100 basis points to 29% as well. And the net profit reported a double-digit growth around 11.7%. Add to that, there was a slight increase in domestic occupancy by about 1% to 76%. And average room rates also increased by about 2% to just shy of the 10,000 mark. 9,900 rupees is what the company reported. But in light of this 5.5% top line growth, the company did continue to maintain their double-digit revenue growth guidance for the full year, because now things are improving. They said that post the first quarter, there was a jump in demand in July itself. In fact, speaking to CNBC, Puneet Chhatwal said that July 2024 so far has actually been 20% higher over last July. That's not all. This year, they are poised to opening 25 new hotels, and they will open at least 2 to 3 new hotels outside of India as well, including a trophy asset in Frankfurt, Germany. So all these things, along with increased wedding dates in the second half, makes the outlook very good for not only the travel industry, but I'll also be watching out for what, something like the other Tata Group company, Titan or Kalyan Jewellers or Senco report in terms of the second half for the wedding jewelry as well. If wedding is supposed to be the driver of hotels, then jewelries would definitely benefit a lot more.
Okay, thank you very much for that. Dipan Mehta from Elixir Equities is with us. Dipan, the entire hotel industry has been in that hospitality upcycle. Barring the seasonality that we've seen in Q1, earnings have been strong. But the question is, at current valuations of 45 times forward multiple, what is the headroom available for Indian hotels for an investor to enter fresh?
Karima, good afternoon. Thank you for having me on your show. First of all, the disclosure that we and our clients are invested in Indian hotels. And yes, I think valuation is the only compromise you have to make when you're buying such a high-class, high-growth company like Indian Hotels. And clearly, I think since Mr. Puneet Chhatwal has taken over, the growth trajectory has just gone to another level. And balance sheet quality also has improved significantly. And the company is focusing on improving its return ratios by going in for more and more management contracts. So I think the growth will sustain for several more years, considering the dynamics of the industry and the position of Indian hotels. But yes, valuations are also on the higher side. So I think investors who are invested like us, we remain invested. It's a hold, but fresh purchase only when there's a 15-20% type of a correction.
Okay, all right. Hi, Dipan. Good afternoon and good to see you. What about Ultratech Cement? The numbers are a little bit disappointing, but clearly I think the street is sending out a message. They want to be with the larger players now, because consolidation is going to be taking center stage. And you don't want to risk it with buying some of maybe these small or mid-cap stocks, because you don't know who's ultimately going to get folded up. What do you make of the stock? It's already had a big run, and valuation-wise, not as cheap as it was, say, 3 months ago, when it was more than 20% lower.
Yes, good afternoon, Nigel. We can continue our discussion on commodities as usual. But I'll point out these 2-3 things. Look at Reliance's numbers, oil to chemical, commodity business. Look at JSW steel business, how the numbers have gone. And look at Ultratech also, which is a commodity business, and what the numbers have come through. So this is the reality of investing in commodity businesses. I've been doing so since the age of 16 and watching these cycles. Commodity businesses per se very easy to understand and kind of invest in them, but these cycles no one can understand, and unless you're really a long-term investor with a 5-10 year type of a view, only then you should touch these stocks and hope that they can sustain volume growth. So this is part and parcel, and none of these stocks, neither Reliance nor Ultratech nor JSW, are really cheap compared to their global peers or what the historical multiples are. So from that point of view, I want to avoid all commodities and look for secular growth stories. That has been, the real wealth creators in India. And all these 3 companies, including Ultratech, I just want to wait and watch and maybe avoid at this point of time, be a little underweight.
Right. No, got that. That's essentially the chief economic advisor, who's of course just presented the economic survey, and we will sort of listen in just a bit from him. I think there's an opportunity for Q&A, the interaction on, of course, what their reaction is or what the perspective was, because I mean it's really strong words coming through as far as speculative trading is concerned. I mean, essentially saying that speculative trading is no place in a developing country like India. I mean, these are some of the strongest words we've heard from a sort of government body, government agency yet. I think there'll be a fair bit on that, and we'll sort of touch upon that as we go along as well. Let's come back to the market. We'll cut to the CEA in just a bit, but Wipro and Persistent are also in focus on the back of fresh brokerage calls. Earnings came through. One is up, the other is down. Rima, tell us more.
Well, let's start with Wipro. 2 reasons. One, the stock had run up a lot. In June, at the beginning of June, the stock price was 440. As of last week, the stock price exceeded 570. So in a span of 45 days, the stock had moved up 30%. So that's the backdrop of the stock price performance. Then came the earnings disappointment. Q1 marked the 6th consecutive quarter of an earnings miss. The expectation was that things are reviving, but it hasn't shown up yet. And even the Q2 guidance at -1% to +1% suggests that at least as of now, there is no recovery in sight. Kotak says valuations are expensive. It's trading at 21 times forward multiple, no margin of safety. UBS says the Q2 guidance suggests delayed conversion of large deals, which will remain a drag on growth, resulting in Wipro dragging peers. But then there are the believers. It's always a bull versus bear. And on the bullish side, you've got Nomura with the target price of 600 and CLSA at 588. Now, if you remember, Persistent was the big casualty on Friday because the street was concerned about the margin performance and the outlook there. But today, the stock has bounced back. Motilal Oswal has upgraded the stock to a buy. Now they're saying the valuations of Persistent are at 40 times. But they believe that there is still valuation upside from here. And according to them, the target price values Persistent at 50 times forward multiple. That, according to them, is the fair value for Persistent, 50 times forward multiple. And it's the EPS growth of 25% which justifies the premium valuation. But Kotak has downgraded Persistent Systems to a sell. Their target price is all the way down, 4,140. They say the sharp movement in the stock price over the last few weeks has led to the stock trading at lofty valuations close to peak levels. So it's the valuation argument both ways. Motilal Oswal believes there is still some upside for valuations to re-rate. Kotak says valuations are at a peak and therefore might come down. Dipan, come in on Persistent Systems. And what about Wipro? There was so much hope built up in the stock price in the run-up to the numbers.
Yeah, Rima, I think you analyze these companies so well that maybe I should be asking you questions in the other way around. But look, I think that large cap IT offers a better risk return profile than something like a Persistent or a KPIT, Tata Technologies or Tata Elxsi, and all these last four mid cap companies have been really high growth companies, and their growth rates have been superior to the industry for several quarters. But these kind of growth rates are not sustainable. Even in case of Persistent Systems, the growth rates have come off a bit. Whereas in the large cap IT, right from Wipro, HCL Tech, Infosys, TCS, from the base at which they're operating just now, I do think that in a couple of years' time, they should get into that double digit or high teens type of growth rates. And from that perspective, their multiples are attractive. So I'd prefer to be overweight large cap IT stocks, although we're not looking at selling Persistent or Tata Elxsi or any of these companies, because you could get a surprise on growth numbers over there as well. But from a fresh investment perspective, I think more should be deployed toward the large cap IT stocks. Just the risk return profile is favorable and industry is looking up. So if once the volumes start to pick up over there, then you could be surprised on the kind of numbers which come through from these large cap IT companies.
All right, Dipan, I wanted to ask you about some of these divestment candidates, so to call it. IDBI Bank, Concord. During the budget and I think post that as well, some of these stocks will be in focus. Fundamentally as well, things are looking good. If you look at IDBI Bank, Abhishek is just telling us that the NPAs is at it's the lowest net NPAs in the banking space at around 0.2%. So fundamentally as well, things looking good. Even Concord, they are guiding for better times ahead in FY25. And also they have that divestment argument. Anything you prefer from here that could be looking at a potential privatization and also has fundamentally strong business?
No, Nigel, I don't think so. I think IDBI Bank, yes, I mean, that could get privatized, but valuations are fair. I don't think you'll get a much higher premium than these amounts, than these valuations. Concord, I think it seems more or less off the table, because if they had to do a Concord privatization, they would have done it by now, but it's just getting postponed and postponed. And I think it's a pretty valuable company, a strategic asset, and could face some political backlash as well. So I would say that Container Corp cannot be bought on the expectation of privatization, and IDBI Bank is pretty much well priced. The real, I think, surprise in this year's budget could be the disinvestment figure and actual follow through over there, because there's lakhs of crores that the government can raise by selling off a lot of the PSU stocks and taking their stake down to as low as maybe 51% or so. And there's good appetite for PSU stocks as well, even PSU banks for that matter. And I hope the government doesn't miss the bus this time round.
Okay, that is the whole sort of expectation around PSUs. Just going back to the market, looking at mid-caps, and quite a few are moving around to discuss, of course, Indian hotels. Some of the good result reactions on the mid-cap, small-cap screen include an Oberoi Realty today, Dodla Dairy. These are stocks that have done well. Even Patanjali Foods, for that matter, about 2% on the higher side. Dipan, hi, good afternoon. Speaking of Oberoi Realty, of course, this is all numbers driven and they had a fantastic quarter. How would you look at some of these larger real estate players, a DLF or an Oberoi or a Godrej for that matter? They've had a good run, but do you think that the earnings or maybe even budget announcements could provide a fresh leg up?
Good afternoon, Surbi. I think Oberoi came with an exceptionally good set of numbers, and it's there in hospitality, it is there in rental business, and that's commercial rental, and very focused real estate projects, mainly in premium locations. And from that point of view, I think this company, I would rate it far higher than some of the larger real estate companies. Godrej property of corporate governance and pan-India presence. But I would rate Oberoi Realty higher than even DLF for that matter. And consistently, they have grown even when the industry was pretty much under stress. Oberoi Realty was doing pretty fine. They kept the balance sheet quality pretty much clean. And they're very selective when it comes to projects. So it's a well-managed company with a very low risk profile. So from that point of view, and valuation-wise also, I think there's scope for multiples to move up over there. So we prefer Oberoi Realty amongst the large, in the large cap real estate companies. I think that looks to be the best bet at this point of time.
Okay, well, we'll take a quick commercial break here. Deepan, thank you very much for joining us and running us through sort of your perspective on things. We come back in just a bit, but we are striving to get you the best of market and macro voices ahead of the union budget. So tune into CNBC-TV18 at 9:05 a.m. onwards on Budget Day tomorrow. We will be live from the NSE with Morgan Stanley's Rhythm Desai, Nilesh of Kotak AMC, Prashant Jain of 3P Investment Managers, and NSE's MD and CEO Ashish Kumar Chauhan. That's coming up tomorrow.
Welcome back. You're with us on Closing Bell. Well, let's now go across to Shireen, who is in conversation with Anish Shah, Group CEO and MD at the Mahindra Group, to talk about expectations from the budget and, of course, the economic survey that has just been tabled. Shireen, over to you.
Well, thanks very much. Yes, we now do have the fine print of the economic survey, which is a precursor to the budget announcements that will follow tomorrow. But let's go across to Anish. Anish, many thanks for joining us here on CNBC TV18. Let's start with what the survey highlights in terms of the growth projections. Sanguine on growth, also sanguine on inflation, saying that growth is steady and inflation is under control. 6.5 to 7% is what the survey assumes as far as growth forecast is concerned, which is on the lower end, on the more conservative side. How do you read this, Anish?
Shireen, good afternoon. We do see this as conservative as well, but from a budget standpoint, it's good to be conservative. We feel that it will likely come out higher than that. And we see a number of other positives in this survey. Inflation being under control is a significant positive. And then as we look at some of the real numbers that have been shown for F24, capital formation is 9% higher. And that's something that is fairly significant. We see unemployment down from 17.8% to 10% at the youth level. And as we look at our demography and our job situation, that is also a very positive indicator. So I see a number of positives coming out in this survey.
Well, speaking of positives, but also trying to extrapolate what we could perhaps see in the budget, I want to talk about what the survey highlights in terms of India's vision of becoming Atmanirbhar. Over 1.28 lakh crore rupees of investments being reported until May 2024, which has led to production or sales of 10.8 lakh crore and employment generation, both direct and indirect, of over 8.5 lakh under the PLI scheme. The ask from industry is that there be more PLI schemes that are rolled out, at least as far as labor-intensive sectors are concerned. Anish, is that the expectation that you go into the budget with? If yes, any specific sectors that you believe deserve to come under the PLI net?
Shireen, jobs is clearly going to be a big focus on the budget. And our view from an industry standpoint is that capital formation, investment is the way to go to create a long-term economy and not something that's done for the short term. We like PLI schemes that have come out so far. And the key factor always is that the incentives that are given should have a meaningful and lasting impact. So in that context, we would probably expect fewer PLI schemes than we've seen before. But what we would ideally like is a greater investment in infrastructure, a greater investment in capex formation that will be positive for the economy in the long term.
Yes, there is a whole chapter on infrastructure, Anish, as you pointed out. But, you know, the indication is that perhaps the government has done a lot of the heavy lifting, especially in the last few years, with record numbers being allocated there as far as public capex is concerned. And now the ask is of the private sector to do its bit. In fact, the survey talks about targeting 35% of private investment to GDP. You know, what do you go into the budget with? Do you expect that it will perhaps do a little bit better than the interim budget in terms of public capex?
We feel that it will. And you're also right that private capex has to step up. It hasn't so far. FICCI's manufacturing survey shows higher capacity utilization across industries and also shows that 47 to 48% of companies are looking at investing over the next 12 to 24 months. And that is something that will help private capex grow significantly.
Anish, you know, you talked about jobs, and the survey highlights that we have seen an improvement as far as the unemployment number is concerned. The survey also talks about the fact that India needs to generate an average of nearly 78.5 lakh jobs annually till 2030 in the non-farm sector. I mean, this is a pretty daunting task, daunting ask to Anish of the private sector, which will need to in many ways do the heavy lifting when it comes to job creation, will it not? Is this doable? Is it feasible?
Daunting but possible, Shireen, because as we look at the Viksit Bharat goals, manufacturing has to grow multifold. Today, India has 3% of global manufacturing. Our target is to get to 12%. If we look at manufacturing as a share of GDP today, it's 16%. And we will need to get to somewhere between 20 and 25%, likely on the higher end. If we get to 25%, it means manufacturing has to grow 16 times in the next 23 years. And for that, India has to be the manufacturing hub of the world. A number of actions are being taken to make that happen, and which is again why we harp on government focusing on long-term aspects for the economy, putting in the capital that's required to add to what the private sector does as well. And that partnership, I think, will help us get to those manufacturing numbers and to those jobs that come with it.
You know, you talked about the manufacturing aspiration, Anish, and the survey throws up an interesting idea or an interesting thought. It's asking for a review, essentially, of the policy with regards to China and saying that in light of this China +1 diversification, India should allow FDI from China to come in so that we actually integrate into the supply chain and ensure that what we're now seeing, with business going to Malaysia and Vietnam and Indonesia, that isn't the case. So the survey calling for perhaps a more pragmatic view of the policy with respect to China. I want to understand how you as industry see that.
So the China policy has been driven by geopolitics. And that's an area that we will leave to the experts to think about. The one area that we will highlight is that across many industries, we are seeing cheaper imports coming in from countries that have high capacities. And we've seen the US and Europe starting to raise tariffs in certain areas as well. So that's one thing that will impact our focus on India being the manufacturing hub of the world, and something that the government will have to look at in terms of how it moderates it.
So, Anisha, the final countdown has begun now for the 7th consecutive budget that the finance minister will present. There's a long wish list of asks that's come in from industry. But if I were to ask you to whittle it down to one or two things that you believe will ensure that this is a budget that is appreciated, it's a budget that will continue to amplify and build on the growth momentum, what would those one or two things be?
So more on long-term economic growth and investment in capital expenditure. Second is less of populist schemes because we need more towards the long term. And third is a focus on jobs and manufacturing.
On that issue of, this business of that the budget could deviate from the recent past and be more populist, is that an expectation that you have? And on the back of what you've seen, for instance, in the survey, and not to suggest that the survey it's only an indicator of what the budget may or may not do, but do you get that feeling that this is likely to be a departure from the recent past with more populism, so to speak?
Actually, the political realities do point towards some element of populism, at least. We were very pleasantly surprised last year when the government did not go down the populist path in an election year and focused on a budget that was long-term and that was good for the country, and a lot of credit to the government for that. But again, there are political realities that have to be balanced.
So finally, from an auto sector's perspective as well, Anish, and the question mark on the FAME subsidies and what shape or form FAME 3 can take. But outside of that, also, confidence building measures, so to speak. What would the expectation be? The two or three things that you would watch out for in the fine print?
We would essentially want to stay the course in terms of where we are right now. I feel that we have got a good set of subsidies. Yes, FAME 3 is essential as a replacement of FAME 2 because FAME 2 has done a lot in terms of having the impetus for change to electric, especially in electric three-wheelers. And that impetus needs to continue for another 3 years for FAME 3 and then stop there. We don't need it beyond that. But that is important for it to continue. So therefore, I would just say stay the course. The rest of the incentives are in place. It's up for industry to now deliver.
Stay the course. That's the message coming in there from Anisha, the Group CEO and MD of the Mahindra Group. And I think that's the message that the economic survey is throwing up as well. The steady as she goes, that's chapter 1 of the survey. And that clearly seems to be the indication that the chief economic advisor is handing out by way of his second economic survey. Anish, always a pleasure. Many thanks for joining us today and look forward to seeing you tomorrow bright and early as we get ready to listen to what the finance minister finally delivers in her budget speech. Guys, that's the economic survey. That's the industry reaction. Back to you for now.
All right, Shireen, thanks very much for that. And of course, all eyes on what actually does come out. But interesting conversation there with Anish. Vaibhav Sanghvi is now with us. He's CEO at Ask Hedge Solutions. Vaibhav, good afternoon. Great to have you with us here on the program. I trust you heard some of what Anish at Mahindra, and of course, leader at FICCI was telling Shireen. on some of the expectations. I mean, your own thoughts. I think from a market perspective, what corporates are expecting is one thing, but I think from a market standpoint, stakes are high because, we've rallied hard, we've done very well. It is a completely different scenario in terms of retail participation now as compared to the last couple of years. So, the higher you go, you start to wonder a little bit more as well. And I think the number one issue is taxation. Are you expecting anything at all, Vaibhav, or you think it'll be status quo?
Yeah, I think, from a taxation perspective, a lot of conversations are around your capital gains aspect and also, around that uniformity of taxes, across investment vehicles. Now, if you see currently, each of those vehicles enjoy a different kind of tax treatment. Say, for example, mutual funds have a particular, fund base or a tax which is in the hands of the investor from a long-term and a short-term perspective. PMS is in the hand of the investor because it's a pass-through. AIF is at the fund level. So all of them kind of having different, system of taxation. So from a capital market perspective, we do think that if uniformity of taxation, the way it's being calculated and the way it's being charged to an end client, will go a long way in terms of developing the whole capital market reforms. That's on the one side. But on the other side, also there are a lot of conversations around the F&O market, and especially on the option side, where there's talk of again STT kind of pulled up, or probably we have rather than on the premium, you charge it on the notional value of the options, and so on and so forth. So a lot of talk around different taxation, but at the end of it, it's currently all speculative, and probably we'll have to wait and see tomorrow how it comes forward from there.
Absolutely. And any tinkering, if it is not in sync with the market's mood, then we know what kind of an impact it can have. Ever good to have you in the conversation. But, that's really the next question. We are at very elevated levels, right? So potentially, apart from tax, is there anything else? Let's assume nothing happens on taxation, at least from a capital market standpoint. Is there anything else that could derail the party? How do you expect, let's say, life to be Wednesday onwards if there's nothing dramatically different on taxation?
See, if there is nothing dramatically different from a taxation perspective, my sense is basically looking at the budget and what the Honorable Prime Minister had to say today, ahead of the budget session, in terms of his vision towards 2047, and also laying a path for the next 5 years in terms of the policy direction as well. In all probability, I think the commentary is going to be pretty strong. So barring, these taxation reforms, if nothing comes up there, then my sense is basically market will, have a sigh of relief. And apart from the normal kind of reaction to any of those budgets, I think we should continue the way we have been in terms of the market. Of course, as you rightly mentioned, Subi, right at the beginning, that valuations at the levels they are, any slight negative, from any quarters, I think can have a disproportionate reaction on the negative side as well. So, and it might be just normal, and it might just be healthy as well.
Hi, Vaibhav. Good to see you in. It's been a while since we chatted. What about positioning ahead of this event? How have you all altered, say, your long-short book in the last few weeks? Because as you said, valuation-wise, we're not cheap, and we have seen a good run as well. So anything that, any kind of disruption could call for a sharper correction. Your take?
See, in our view, or as our thesis goes, or as our DNA goes, I think in a long short fund, when we are focused on absolute return, ahead of any big binary events, we are highly hedged. So at this point in time, if you ask me, we are close to about fully hedged in terms of our books. We don't take any call ahead of any big events. Let the event pan out, look at what's coming from there, what the outcome there, and then reposition our portfolios. But having said that, while we are extremely cautious investors because of our hedge mandate, my sense is basically, as I said earlier, at the level of valuation, the scope of disappointment is very, very less. If there is some amount of disappointment, then the correction can be pretty sharp.
Let me ask Prashant this actually. Prashant, so obviously this is all speculation. Hypothetically, if there's no bad news on tax tomorrow, then what? Just a relief rally, all-time highs once again.
I mean, how much? I mean, I think we were 1.5–2% away.
About just 1.5% away from it, so another high.
That's possible, right? I mean, that's absolutely possible. But think about it another way. We were talking about the interim budget, which was presented in February. Now this is the full budget.
Yeah.
But now this is it's happening in July, which means
February. It's a 6-month budget.
Exactly 6 months. You'll have another budget, right?
Yeah.
So, would the government want to really do something big and dramatic in terms of, rejigging the entire taxation regime when you have a full budget in 6 months' time?
Yeah.
I think that is another thing to ponder. But I mean, if the taxation bit does not, I don't think there is widespread expectation it will come. Actually,
I think there's just fear-mongering, a lot of fear-mongering in the last couple of days.
Actually, if you had to sort of count the number of people, which you can't do, but I think it'll be in the minority. There are only few who are expecting something will come. The majority is saying, well, I don't think, but at the margin, of course, that the thing is always there. So maybe, as you say, maybe a little bit of a relief move, but we're almost there, right? I mean, the market's pulled back hardly anything. 1.5–2% or so. So who knows? Just a quick word, Weber, on telecom as a space, especially in names like Indus Tower. Actually, Indus Tower, because I mean, others you've got to take an individual call, but Indus, of course, caters to the entire telecom market ecosystem in that sense. I was reading a note from Citi, which is just out, and they're talking about the next leg of price appreciation for the stock. They're saying the price target, they're calling a price target of 500 rupees, lots of triggers, which will be positive for underlying telecom stocks as well. I mean, for example, the curative petition in the Supreme Court, tariff hikes starting to come through. They're expecting the company to present an update on tenancies, etc. Do you own it? Stocks up 100% this year, to be sure. Weber.
Yeah, I think, Prashant, I mean, from a business opportunity perspective, from telecom side, I think nobody debates in terms of the long-term opportunity which is there. Till now, what has been happening is basically because of the high capex, the commensurate free cash flows was something which everybody was missing from the whole sector. Now that post-tariff hikes and in the whole ecosystem getting pretty healthy, my sense is that every decline or every dip, this is a sector which would be bid into or bought into. So while the business opportunity is fantastic, valuations are slightly richer compared to your averages, but as I said, just that because all the headwinds, are out of the sectors, and now we are looking at some amount of tailwinds in terms of tariff hikes, and balance sheets can, getting in proper shape by reduction of debt. I think this is a sector will continue to get, constant interest going forward as well.
Okay, all right. Vaibhav, appreciate you joining in and filling us in with your quick take on the markets. Looking forward to chatting with you post the event. Well, for the time being, though, let's keep an eye out on a few stocks that are moving around. At the bottom of your screen, you have that Citi note on Indus. They're talking for the next leg in terms of an uptrend on Indus Star. So that stock has moved to the high point of the day. V-Mart, all of a sudden, volume spurt out there. And that stock as well has moved to the high point of the day. I think it's up close to around 10%. And the other one is Vedanta. The stock has seen a correction post that QIP. It went to around 440 rupees odd. There was rather strong demand, but it's underperformed for the last week or so. So that one as well has made its way to the high point of the day on rather large volumes. But a good time to get to our favorite segment, T-Street Chatter. Nimesh joins us. Nimesh, what are you picking up in terms of today's action?
And Nigel, it's a wait and watch. But before I talk about the markets, a word on Vedanta, I guess the stock will get out of the F&O ban as well. I guess that's the reason why you're seeing a bit of a up move there. Okay, broadly on the markets, it's a wait and watch ahead of the big budget announcement tomorrow. I think everybody's waiting and watching on the maybe if there is a taxation on equities. That's a big debate point, right? But if that doesn't have to come, then you might see a bit of a pullback rally as well. Largely because the positions are on the lighter side. A lot of funds have raised cash levels. A lot of HNI investors whom I know, they are sitting on the sidelines and waiting for a dip. So if there is no big negative surprise in the budget, you might see a bit of a pullback rally in the overall markets as well. So that's something to watch out for. Having said that, the broader markets have really outperformed today. The index is up nearly 1.5%, and that's largely because of the retail flows, and that was missing on Friday. We saw a sharp correction in the broader market stocks on Friday on the back of the global outage, and a lot of retail participants couldn't participate or buy. That seems to be not the case today, and hence you're seeing a bit of retail inflow back into broader market stocks today. From a larger institutional point of view, it's quite muted, is what I understand. The flows are quite muted. There is not much activity, both from the FIs or from the DIs, and rightly so, because if you look at the large cap names, most of the earnings over the weekend in the large cap basket has relatively underperformed or have been a disappointment, right? So earnings would be a big trigger to watch out tomorrow, but post that, I guess the bigger reactions will come on the individual earnings, and that's going to be a big trigger to watch out for. So earnings will set the tone, but I guess if there is no big negative surprise in the budget tomorrow, you might see a bit of a sharp pullback rally as well.
No, that's right. No disappointment is something that we're looking forward to. And I think, Nimesh, a couple of points. The retail flows have been solid. The FI flows into India in comparison to other emerging markets has been good. And that piece you put out as well, that the mutual funds have raised their cash levels from around 90,000 crores. I think it was 1.2 lakh crores as
Absolutely.
well. So ample liquidity waiting to come in.
Exactly.
If there's no.
So what I put out was only mutual funds. If you add to it the SIP flows, if you add to it the kind of cash levels the PMS are sitting on, there is ample liquidity in the system. So my sense is if there is no negative surprise in the budget, you might see a bit of a buying squeeze as well.
All right.
That will be something to watch.
Let's get to the interesting part then, Nimesh. Individual stocks.
Well, there is a lot of, while the earnings are going on, there is still a lot of chatter around large block deals. So the first name is Sula Vineyards. That stock has been in a very narrow range for the last many months now, been largely consolidating. But now I understand there could be a clean out trade very soon in Sula Vineyards. The global investor, one of the large global investor, is a likely seller there. They've sold a large chunk in the last 1 month, and now there could be a clean out trade. So that's something to watch in Sula Vineyards. The second name is Root Mobile. While the stock is under pressure after Q1 earnings, even there the chatter is that there could be a large block deal in Root Mobile very soon. Remember, the promoter holding is at 83%, and they need to bring it to the minimum public float norm. So the large block will come from the promoters, and now that the earnings are over, that's likely very soon. The third stock is PI Industries. Big move in that stock and large volumes as well. Largely because I understand the selling pressure from a leading FI is largely over. There was a small block in the morning, and post that, we've seen a big reaction there. And the last one is ICICI Lombard. Post earnings, we've seen a bit of a positive reaction on that name as well. The volumes are on the higher side. I understand there is a very strong buying interest from larger FIs. And Morgan Stanley had put out a tactical buy as well in the morning, and they'd raised the target price as well. So on back of that, a bit of up move in ICICI Lombard as well.
Okay, got that. Thanks very much, Nimesh, for all of the buzz out there. Markets absolutely flat, just 15 points lower. And HDFC Bank, Lever, which is reporting numbers tomorrow, and Infosys. These are 2 or 3 strong stocks that are ensuring that there is no wider decline. These are the top movers on the way up in terms of the top weightages. Let's take a break on that note. We'll come back on the other side, and we'll get you some final trading calls with Mitesh.
Okay, welcome back. 20 points lower on the Nifty. 24,500 is where we are at right now. Now, the economic survey, which came through earlier, is parsed for any hints on what the budget may actually present. Lata is here with some of what she picked up could be markers for tomorrow. Lata, over to you.
Well, first up, everyone looks for what is their growth forecast, because if the growth forecast in the budget changes, I mean, if it becomes higher than expected, then automatically the percentage of the fiscal deficit will look smaller without you having to do anything. But that kind of a hint is not there. It's a very moderate, middle-of-the-road kind of assumption of 6.5% to 7%. If you add the 4.5% CPI forecast of Reserve Bank and probably around a 3% WPI forecast, inflation is actually lower. So the 10.5% that they have gone with in terms of nominal GDP growth in the interim budget, there's no reason to change it. Even the tax buoyancy, which we were all expecting would get worked into the new numbers, if you're very modest in your growth aspirations or your growth expectations, I'm not even sure that the tax assumptions are going to be scaled up much. So if anything, the bond markets, after that initial enthusiasm, is back to where it was before the survey. There isn't so much expectation that there will be a huge cut in fiscal deficit. There is still the one-off RBI dividend. What they will do with it remains a question mark. But there is no extra assumptions that, oh, we can do welfare and we can do capex and we can cut deficit. That enthu has gone down a bit. With respect to stock markets, the big worry was about what do they think about the surge in stock prices. And there, the CEA leaves you in no doubt that he is worried about it. I'll read just two quotes, but I can pick 5 or 6, just at the snap of a finger. One quote, very serious warning on, the quote, the financialization of economies has not ended well, even for advanced economies. And then there are many, many examples. Another quote, all stakeholders, capital markets, regulators and government must ensure that capital markets play their theoretically assigned role of directing savings to their most productive investments. It is not just in the national interest, it is also in their selfish interest. So here again, seeing what the SEBI chairman said, they must go for capex and must not go for speculation. And I'm only picking 2 points again and again. So clearly something will come now, whether it will come in the form of taxes or whether it is a directive from the government to tell SEBI, you better be a nanny regulator. We don't know. So that still leaves a question mark, but we are not in doubt that the F&O volumes and the market surge in general has not been taken too kindly by the government. And finally, there is some mention of inflation targeting. Remember, now the current inflation targeting framework targets 4% headline inflation. But there is a small paragraph which says that maybe we need to review that targeting and exclude food, because that can't be impacted by interest rates. And it is coming in a context where they want to encourage farmers. I mean, among the many things you can do to farmers is don't take off options trading at the first hint of, some commodity price going up. Don't ban exports at the first hint of a price rise. And the third thing they say is maybe you remove food from the inflation targeting scheme altogether and make the Reserve Bank target a food excluded inflation target. Well, I don't know if this is a very serious suggestion or it's just one of the many, but this is something the bond markets will chew over. It's not immediate, but we will have to wait and see. Those, I think, are the key takeaways. Okay, there's one on China, if you wish. On the external sector, when they discuss, they say that geopolitics, of course, dominates even our relationship with China. But rather than get into the China-dominated supply chains, which is what many nations aspire, let us look at encouraging FDI from China, because clearly exports out of China and imported into the US could be threatened sometime soon. And, if the Chinese money is routed through India in the form of a manufacturing investment, that may be one way to look at. Of course, this is subject to all geopolitics, but that's just a suggestion.
All right, Lata, thank you very much for that. So that's a nice, tight wrap out of what the economic survey really puts out. And all eyes, of course, now on the budget tomorrow. Mitesh Thakkar is with us. There is, I think 10 minutes to go for market closing. We're around about 20 points. So just treading water, neither here nor there. But to be sure, Nifty is down because Kotak is down, Reliance is down, and Wipro is down. I mean, so it's not a broad-based sell-off. Broader markets are doing well. Mitesh, actually, the story of today has been the bounce from the lows. not the subdued, flattish kind of price action. So how would you take it, and what are your trades now?
As I said, I think, Prashant, the idea could be that before the event, even the short traders may not be very aggressive and they would want to hold their horses. I think it's a market which will take some kind of directional movement post the event tomorrow. But for the timing, so therefore trade with light volumes, even if you are trading. On the BDSC side, I think Sun Pharma is what I would recommend. Keep a stop at 1580. Look for targets of around 1600 plus here. And an STBT on telecommunication with a stop just above 1795 for targets of 1760.
Okay, all right, got it, Mitesh. Thank you very much for that. We do have to take a very quick break. Very quiet on the bank Nifty and the Nifty. HDFC Bank is doing really well, 2.5% up. But the rest of the large cap screen is very, very subdued. We'll take a break, come back, and then get into the last leg of today's trading action. Welcome back. You're with us, and we are in the last chapter of today's trading action. Just looking at some of the Nifty winners, I mentioned HDFC Bank, where there's a sigh of relief. Remember, the stock really sold off once we got the quarterly update. So the fact that there is hardly any business growth, that was known. But I think it's the margin expansion that the market has really latched on to. Ultratech Cement is recovering from the blows that it received on Friday. There's some buying on Tata Steel, Hindalco as well. Some of the metal stocks are also bouncing back. Anand Tandon is with us. Anand, okay, I'm going to ask you one of those questions. Budget, right? So it's that time of the year. Let's say, if you were to go beyond taxation and if you were to look at one or two stocks or three stocks which could remain key beneficiaries of the overall policy direction that the government is expected to take, then which would those be? I'm not asking for a budget trade for tomorrow, but in general, a play on favorable policy.
Well, the first question is, what do you determine as favorable? Because, by and large, given the fact that you leave a bunch of bureaucrats in a room, the only thing they can come up with is to mess up whatever goes right. So from that context, you have to assume that they will do something to stop the market from performing better from here on. Which brings you to the question about which sector to look at. I think the one sector they may not end up doing badly with is the banking sector, because that is key to many of the plans that the government may have in terms of being able to grow. And that's been a relative underperformance. So, you can continue to be overweight perhaps on that sector.
Okay, no, I've got that. Anand, any specific hopes from the budget tomorrow?
Well, as I said, the best would be to say business as usual, not to do too much. The reality is that that's not likely to happen. So we are going to get the first 40 minutes about farms and how we should be increasing productivity with no difference other than the fact that, some allocations will be increased to farms. There may be something in it for the urban poor. I'm not sure. If that happens, that could increase the kind of coverage that you have for the weaker segments of society. And given the kind of noise that we are talking about in terms of options, etc., there is bound to be something disastrous there. So, either it will be tax or it will be increasing the size of the contract or any of the above, which will make sure that that market actually collapses from here.
Well, that's pretty certain of it, Anand. I don't know. I mean, we'll see what comes of it. But one hopes that it's measured, right?
So I'm not sure what exactly is the motivation, because if you were to put it down and say, okay, the reason we are interfering in it is because the retail investors or traders are losing money, well, then there are lots of other things to do. You can actually put a UTI 64 scheme back in the action. The reality is that the market is meant to allow people to express their views, and if that means that they will speculate, so be it. If you want to get people to speculate, let's give them in the markets, give them other alternatives. The Hong Kong horse racing was the biggest thing which helped the Hong Kong University set it up and make it one of the largest and the best performing universities in the world. So horse betting is a great idea. And, instead of stopping that, you should perhaps allow that.
Anand, you're in a mood. Anyway, thanks for that. But, I'm going to come back to you in just a bit. Let me just wrap out things here. We are up, we're down about 15 points, but we're up quite a bit from the day's lowest point on the Nifty. That's the closing, those are the closing rates, 24,515. You've got the Nifty Bank, which is up about 65 points. We're at 52,330. The sensex is largely flattish, unchanged. Mid and small cap indices, though, have staged a recent recovery. Friday, those indices were down 2%, more than 2% today. You got about a 1% odd gain on each of these indices. Market breadth is positive, and I think about 1,500 stocks are higher, 1,100 stocks are lower on the NSE. And you also look at, the PSUs. I think the PSE index, the CPSE index, these are some of the stocks sectors which did well. I mean, large earnings-specific reactions, right? You look at Reliance, the way that's, which was, of course, a big drag on the index. There was Kotak Bank, and of course Wipro, not that large a weight, but Wipro, of course, in absolute terms, saw the largest price damage after the earnings. HDFC Bank was pulling the other way, and it was doing, I think it added about 50 odd index points with a 2% gain, more than 50 points actually by close. So 1642 coming through on HDFC Bank. So that's essentially the session that we had. It's a wrap on this edition of Closing Bell, but stay right here. Rima and I'll get you Markets Forward, which will come up in just a bit from now. Stay with us.